Good evening. My name is Kingsley KK. I'll be taking you on capital allowance. But before we define capital allowance, we should get to know the reason why a taxman decides to grant companies qualifying capital allowance. The reason for this relief was due to the fact that depreciation is disallowed for income tax purposes. You see that when preparing your sale profit, you see where you have on the format add back depreciation. So to this effect, what the tax authority did was to bring up a form of relief that will be granted to these companies based on them using a qualifying capital expenditure. If we were asked, what is capital allowance? Capital allowance are a form of relief granted to any company which incurred qualifying capital expenditure for the purpose of trade or business during a basic period, irrespective of non-current assets that are in use at the end of the basic period. What it simply means is this. But before we go further more, what do you understand by qualifying capital expenditure? Qualifying capital expenditure simply means expenditure incurred on assets for the trade business which in a particular basic period. Examples are machineries, buildings. Then what they mean by irrespective of the non-current asset that is used at the end of the basic period simply means that either the asset is bought at the beginning of the year or the asset is bought at the end of the year. It means that capital allowance will be granted. So that's why so when we go further more, we see that we have types of capital allowance. We have up to 7 or 8 of them, but we are going to focus on 5. The first one is the initial allowance. This is a relief that is granted in the year of assessment in the basic period of which a qualifying capital expenditure was incurred. This simply means that once an asset is bought, either it's gotten by January, for instance, or by December 31st, for instance, it simply means that you will grant a particular percentage based on the qualifying capital expenditure and initial allowance. And remember that this allowance is granted once. Is granted once in the life of any asset for as long as it is beneficial. As long as that asset is being used by the company, that what we call that it must be granted an initial allowance. The next allowance there is annual. From the word annual, it simply means yearly. Annual allowance means an allowance that is granted yearly on every qualifying capital expenditure. So it simply means that this allowance is granted on a qualifying capital expenditure. Define a capital expenditure. So, and note that this annual allowance is computed on a straight line basis. How do you mean a straight line basis? It means that to get your annual allowance, it means cost minus initial allowance, all divided by the number of years. And how do you get this number of years? it means that we are going to divide 100, because there is a percentage, by the annual allowance rate. Then getting that number means that this asset will stay this number of years before getting this scrap value. So then when we go into computation, at least we understand much better. Then the next we're looking at there is balancing allowance and balancing charge. For each define a balancing allowance or a balancing charge, the major difference is between the tax written down value and the sales proceed. Sometimes students find it difficult to differentiate this. They will take the information for allowance, for charge, and the vice versa. But one thing you should note that when we're talking about a balancing allowance or charge, the major thing we're looking at is the tax written down value and the sales proceed. And also note that proceeds can be also in form of insurance claims. Then when the tax written down value exceeds the sales proceeds, or when the tax written down value is higher than the sales proceed, or when the tax written down value is big, has bigger amount than the sales profit, then the difference between both is called the allowance. But a situation whereby the sales proceed is greater than, or exceed, or is higher than the tax written down value, then we'll say there is a balancing charge. The next thing we have to look there is the investment allowance. The investment allowance is an incentive. It's an incentive granted. It's an incentive granted where a company has incurred a capital expenditure on plant and equipment, or on plant and machinery, and the rate of this allowance is 10% of any qualifying expenditure. The next we're looking at is the rural investment allowance. When you're talking about the rural investment allowance, it's an allowance given in addition to an initial allowance to a company which incur capital expenditure or the provision of for facilities such as water, electricity, or tar road for the purpose of the business, which is located at least 20 kilometers away from such facilities provided by the government. So on this note, the allowance will be when there is no facility at all in the environment, that particular place will give them 100%. When there is no electricity, but there is water and tarred road, 50%. Where is water, no electricity, and no tarred road, and when there is no water but there is electricity and there is tarred road, give them 30%. So when there is no water, 30%. When there is no tarred road, 15%. Then we'll have the capital allowance raised, and we also have the restrictions. Below, what we are seeing now is the capital allowance rate, and then in percentage. Hereby we'll have the first one, which is initial, and the other one is annual. And the building expenditure will have it to be 15% for initial, while 10% is for annual. You see, we have industrial building, have building expenditure, we have industrial plant expenditure, we have mining expenditure, down to research and development expenditure. Then we talk about the restrictions for capital allowance. Capital allowance can be deducted from accessible profit of companies in any year, are restricted to 3% of the accessible profit, except for companies engaged in agri-aligned industry and manufacturing industry. But note, the capital allowance is also restricted when there is a private use, restricted amount granted to official use, and the basis period is less than 12 months, we restrict amount calculated to the number of months in the basis period. Then what is this basis period for capital allowance? Note that the basis period for capital allowance is the same as that of assessment of the profit of the year. This means that capital allowance are given an assessment year in respect of assets acquired or qualified during the preceding year of assessment. So these are when we start solving, like, we understand very well. So if there's any question so far, you can ask, can drop on the message box. So let's respond to you. There's no question. If you have any question, drop. There's no question. When we come in our next class, we start with this computation. But look at it. The company makes up its normal account 30th June each year, acquiring the following assets. Acquire the full asset. We're saying the date which was bought and the asset that was purchased and the cost. Looking at the date, you see that only one asset was gotten in the year 2011. Then two assets were gotten in the year 2012. Then only one asset was gotten in the year 2014. So based on what we explained in the initial allowance, we explain either even if the asset is gotten on the last day of the year, like we see here that this building was gotten on the last year of the year, you see that we are going to grant it capital allowance and both initial and annual. Yes, because it's bought in the particular. That's why it's advised by tax, but it's advised to buy assets at the end of the year and dispose assets at the beginning of the year. So that one of the advice. So when computing, you see, we'll bring in the computation very well so you understand well. See you in our next class. Thank you.